Well, it looks like the PMI numbers are starting to trickle in, and they're showing red. In other words, they're down below 50, and actually, like somebody stated, you're probably going to be significantly above 50. When you're considering the inflation rate, you consider that you're actually getting real growth. But if you're below 50, you're solidly in negative growth. You're in retraction. Now, a lot of it's coming from the automotive industry, which bodes well bad for palladium and platinum. But that may be not just that may not be the overall automotive industry. It may be more in the Western and Japanese and European, because what's actually driving the industry and demand for all industrial metals, including silver, is still China. Even though they're having a contraction, they got plenty of money. They have plenty of money, and like Brazil, the BRIC nations. And India, even though India is not doing so great, they still are in expansionary mode. There's an entire class of people out there looking to get into the middle class. Now, one area of the country that looks like we're down a lot is Milwaukee area, which includes Detroit, and I got the numbers here. Now, I don't have all the numbers for everywhere in the world, but we got some preliminary numbers, and they all look bad. Now, will this be enough to cause Bernanke to act on QE? Probably not, because what we need is a stock market getting clobbered. And the stock market seems to be holding up. Well, you know what this is reminiscent of? The 1920s. Doesn't make sense, does it? Doesn't make sense. Like the whole economy's slowing down everywhere, but the stock market's holding up. And you know what's going on, since they had the plunge protection team created since Reagan days. The stock market can really be held up in a lot of different other artificial ways. It may have to do with election year, but who knows? I mean, in 2008, the stock market crashed before the election too, along with commodities. Now, we've already seen the commodity prices crash a little bit. They're down for this year. And stocks have still been holding up. Well, I got to comment on a couple other things. Now, as far as manufacturing goes, manufacturing automobiles is a big sector of the manufacturing economy in the United States. I'd imagine if they had some crazy entrepreneur out there like John DeLorean, he'd be going down to Arizona getting title for cars like these old ones, and basically gearing up for the remanufacture of these cars. You could still sell them as 1959s. I wonder how many people would buy those. Quite an interesting thought. I've always thought, we don't have people that think outside the box anymore. But anyway, getting on to the purchasing managers index, Japan went down a lot. Japan manufacturing purchasing managers index fell to 47.9 for July 2012. From 49.9 in June. Now, this is another one. This is another biggie, though. The index for new Japanese export orders fell to 43.2 in July 2012 from 47.5. That's the biggest, sharpest decrease they had since the typhoon, the tsunami, and the earthquake. Well, I guess it was just a tsunami and earthquake. So this is bad news. So that's as bad of contraction they've had since early 2011. In the U.S., and I was mentioning about the automotive industry, this is Detroit. Detroit looks bad. Detroit's probably slowing down left and right. In the U.S., the Milwaukee PMI fell to 46.7 in July 2012 versus 60.2 in June. Now, I don't even trust these numbers, to tell you the truth, but you're showing a direction. The direction has a sharp downward trend. Now, Chicago, it came in a little bit better than they expected. They thought it was going to be like 52.5. It came in at 53.7 for July, down slightly from 54. Probably cooked numbers. Probably. That's my opinion on this. That's just my opinion. I think they're cooked numbers. But, you can really tell what's going on. You could take the commodities in the world, and the garbage index is something else I mentioned before, which was the garbage being railroaded in freight cars around the country. It's like totally crashed. In other words, less people throwing away stuff. You know, that means less people are buying stuff. So that's a better indication than this stuff that's going on. And those are numbers they probably tend not to bother with cooking because nobody looks at those. But that garbage index follows the GDP very carefully. So I think, the one thing that Bernanke's got to do, though, he's got to see the markets crash. Now, still the Dow is over 13,000. The S&P, nothing's down that much. I mean, the markets are down a little bit today. Silver was down a little bit today. But nothing was down that much today. Now, Bill Gross, he's been talking about the stock market lately. And basically, he's saying that's not the place to be, period, the stock market. Now, Mark Faber's about 25% in equity stocks, but he's mainly in, hand-picked Asian stocks. He's not messing around too much with the U.S. stocks, any of the Western nation stocks. He's mainly in hand-picked Asian stocks. So I think, to me, I'm going to say right now, my common sense says every damn thing is down, right? Everything's down. It indicates production's down. The PMI's down. We got some inflation going, so despite what they say. So when you got an index even 51, you probably got a contraction on a PMI. And like I stated, the commodity prices are down. The big one I thought was the garbage index, which has a very, very high correlation to the GDP. The GDP is not going down, but the garbage index has crashed, It's down to like 2008 levels. So something isn't adding up with this. But now we got some new numbers stating, last month was a bad month. This is even going to be a worse month. So that doesn't bode well for the metals unless we see QE coming up. Now, this week is not over yet. There could be a bunch of different things these people could say because one word out of, say, Mario Draghi's mouth or Ben Bernanke's mouth could send the markets flying again on speculative impulses. But, it looks like the reality numbers are not there yet, as far as, good production and that type of stuff. Now, actually, this does not bode well for, like, the industrial metals like silver, platinum, and palladium, which I'm mainly in. You have to have, if you look back at the lesson in 1979 when those metals all flew, and as a matter of fact, palladium and platinum did as much of a percentage increase inside of a year as silver. A lot of people don't recognize that, but all three of those metals did about the same percentage increase. There was very, very low unemployment, and there was a hell of a lot of production going on, except there was a lot of inflation too. So that's what caused it to freaking fly like that. And when it crashed was when the economy went into recession. It wasn't just over the interest rates going up and the margin rate, all the rules they made, to stop the price from rising and stuff. It was also like later on, a recession came into being, and that really knocked down, the prices of the metals. Now, how, it's almost like a tough question, or, if there's a hard recession out there right now, and that's what it looks like, it's not going to be easy for the metals to go up just by fundamentals. It's going to have to be by monetary policy. And actually that will do better for gold. Now what actually could drive up these industrial metals is a curveball that we have today versus like we didn't have back in 1979, because you just can't compare one era to, even though that wasn't that long ago, 33 years ago. What we got today is China, India, Brazil, maybe even Russia too. Who knows? I don't know how well they're doing over there, but mainly China, mainly the Indian nations, India and Asian nations, Vietnam, that type of stuff. They could actually bring on a hell of a lot more production, even domestically, through stimulus money that they have plenty of money saved up. So that could actually drive up silver, platinum, and palladium, a lot faster than gold. That's one thing that's different about 1979, whereas we might be experiencing all the wrong conditions for those metals to fly. Globally, the picture is totally different now, and we got Asian competition in the world for those metals, so there's going to be a hell of a lot more demand on it. But just a little bit of caution. Now we know equities are being bashed by Bill Gross. Mark Farber's partly into equities, but he's into certain select Asian equities. So you might see this Dow crash. I personally think so. It doesn't add up. And like something else I was talking about before was about the the Dust Bowl practically we got going on here in the United States. I mean, it's not as bad as that I think it was 1936 or whatever. I'm not sure the act. There was like 2 Dust Bowls, but it's not quite as bad as that, but it's getting a lot worse than even the one they had back in 1983, because it's going to continue for a few months. So that bodes very bad for the economy, because it's going to take a lot of discretionary spending out of the hands of people, where they're going to have to spend it on food, right? So they're not going to be buying hard goods and stuff like that. So it looks like very bad for the economy versus in the local U.S. economy, the European economy, and the Japanese economy. Chinese, I know they're down, but you know what? They're not going to be down for long, because the government's just going to keep them at 8%. They're too scared of a revolution. That's why they're going to keep stimulating over in China. It's going to be like a kind of a just a quick downturn. They're going to keep their 8% growth rate one way or the other. So, the demand for commodities, about 60% of the global demand for all commodities comes from China alone, and in India, Vietnam, Brazil, and, other Asian countries. And guess what? That's most of it right there. So, even though these numbers look bad for the West, initially it could drive down the prices of silver, gold, platinum, palladium, and all that type of stuff. But it does depend a lot on what the people will say with Mario Draghi and Ben Bernanke. So it's going to be an interesting situation. And I'm just looking at the metals are probably going to fly at one point in time because of process of elimination. In other words, the Western equity markets are basically in a bubble. The bond market's in a bubble, right? Now, the European stock markets are probably a better investment because they are depressed, but the Americans aren't. So, if people lose another 40% of their income like they did back in 2008, 2009, due to piling all their money in bonds and some keeping it still on U.S. equities, guess what? They're going to be panicking to what's left. Maybe the metals. So silver might do okay, it may. Even though it's a little different situation this time than it was back in 1979. It may do okay, even without high production in the United States and low unemployment. It's a global situation.